Good morning, everyone, and thank you for choosing Market Briefing analysis of today's financial news. Every day, our goal is to provide you with a thorough and knowledgeable analysis of the most relevant financial news to help you navigate the complex economic landscape. Let's begin our daily review. Daily International Market Performance Report based on the news of the last 7 days, June 9, 2023. This week in the financial markets, there have been several key developments that have caught the attention of investors. Let's dive into the details. The week started with a wave of reports on the job market. While wage growth has slowed, it remains strong enough to justify the Federal Reserve not taking a prolonged pause. Major stock benchmarks ended the week in the red, with the S&P 500 down 1.2% and the Nasdaq 100 down 0.9%. The trigger for the surge in yields came from stronger than expected private sector employment data from ADP. The report revealed the creation of 500,000 jobs last month. Although ADP data often differs from the official employment report by the Bureau of Labor Statistics, BLS, both reports provide little reason for the Fed to hold off on raising interest rates at this month's meeting. After the strongest first half for the S&P 500 in 5 years, skeptics are retreating, with bearish positions in exchange-traded funds hitting 3-year lows. Large speculators have been unwinding their short positions on the S&P 500, resulting in the largest decrease since mid-2020. Short sellers have likely lost $37 billion in June, according to Ortex, an analytics provider. The percentage of bullish newsletter authors has risen to 54.9%, while the percentage of bears has dropped to 18.3%. This rapid shift in sentiment has even prompted some early proponents of the bull run to question whether there are too many optimists in the market. Systematic funds, including those that allocate assets based on price dynamics and volatility signals, have been net buyers of $45 billion in global equities in June. This has pushed their equity exposure to the highest level since February 2020, ranking around the 80th percentile of the past 5 years. Market participants are eagerly awaiting more economic data and second quarter earnings to gain a better understanding of the fundamental outlook. In the currency markets, the dollar has returned to near 3-week lows after the jobs report. Bitcoin has remained relatively stable around $30,000, while oil prices have increased, with WTI approaching $74. Gold has seen some intraday fluctuations but has overall experienced an upward trend. Moving on to the oil market, there are indications that the recent OPEC Plus cuts, led by Saudi Arabia, are starting to have an impact. The North Sea weekly swap contracts are now traded in the greatest backwardation since mid-May. Put options on Brent have lower premiums than call options. Murban futures premiums have risen to over $2 per barrel compared to the Dubai benchmark, indicating tightness in the Asian crude market. Backwardation in the European diesel market has increased this week, highlighting strength in fuel markets. In the United States, prices for crude barrels that could serve as substitutes for OPEC barrels have risen, with Mars, the benchmark for sour crude, reaching a nearly 3-year high. Houston WTI, a significant export grade, is trading at the highest level since March. The recent gains along the oil futures curve follow Saudi Arabia's announcement to extend its 1 million barrels per day unilateral supply cut into August. On the other hand, Russia has stated that it will reduce exports by 500,000 barrels without reducing production. Improved demand in the United States during the summer driving season, along with accelerated refinery activity, has contributed to the strength. U.S. crude inventories have also declined for the third consecutive week, reaching the lowest level since January. In a surprising move, Saudi Arabia has raised crude prices for shipments to Europe and the Mediterranean, unexpectedly increasing the cost of supplies to Asia as well. Now let's shift our focus to the global bond market, where there has been a major setback. Continuously robust U.S. economic data has caught bond investors off guard, as they had previously been buying bonds in anticipation of a slowdown in growth. Bonds are now being sold due to concerns that inflation will remain above the 2% target, forcing policymakers to further raise interest rates. Before we continue with our analysis, we'd like to remind you of your support for our channel Market Briefing analysis of today's financial news. If you're enjoying this video and find our content useful and engaging, please consider giving it a thumbs up and subscribing to our channel. This helps us grow and bring you even more quality content. Now, let's get back to the financial market news and the latest updates. 2-year Treasury yields have reached their highest levels since 2007, and the 10-year Treasury yield, the global benchmark, has surged above 4%. This bond sell-off has spread beyond the US, with the global government bond index reaching levels not seen since the financial crisis. In Australia, the 10-year bond yield hit its highest level since 2014, while the New Zealand equivalent reached its highest level since 2011. Yields on Japanese benchmark bonds are approaching their 0.5% peak. The stock market, which had previously ignored consistently higher bond yields in recent months, has begun to falter. The VIX has risen at the fastest pace since the peak of the banking turbulence in March. The 1-month correlation between 10-year yields and the S&P 500 has turned negative for the first time in 3 months, with Treasury bonds falling alongside stocks. Although this week's market moves pale in comparison to the volatility observed last year, they indicate growing discomfort among investors. While the spread between junk bonds and Treasury bonds remains near the lows of the year, the yield curve remains inverted, from the US to Germany. Lastly, in the US job market, non-farm payrolls, NFP, disappointed for the first time in 15 months. Job gains moderated in June, but wage growth remained steady, indicating a strong enough labor market to keep the Federal Reserve on track to raise interest rates this month. Non-farm payrolls increased by 209,000, the smallest gain since the end of 2020, falling below economists' expectations. The unemployment rate dropped to 3.6%. The hiring was concentrated in a few sectors, namely healthcare, government, and construction. Average hourly earnings increased by 4.4% compared to the previous year. The mismatch between labor supply and demand is reaching a better balance, partly due to increased participation. While the overall labor force participation rate remains stable, the rate for people aged 25 to 54 reached the highest level in 21 years. On the day before the Department of Labor report, ADP Research Institute data showed that U.S. companies added nearly 500,000 jobs last month. Additionally, other numbers, such as unemployment claims, suggest a strong labor market. This week has seen various market developments that have captured investors' attention. The job market reports have shown signs of strength but also some moderation, which has implications for the Federal Reserve's decision on interest rates. The stock market has experienced a shift in sentiment, with skeptics retreating and bearish positions diminishing. The oil market is showing signs of tightening, partly due to the OPEC+ cuts. Meanwhile, the global bond market has experienced a setback as solid U.S. economic data has challenged investors' expectations. In conclusion, we'd like to thank you for watching Market Briefing analysis of today's financial news. If you enjoyed our insights and found the information helpful, please consider leaving a like and subscribing to our channel to stay updated with future analyses. Thank you again for your support, and we'll see you soon with more news. Remember, the information in this video is purely informational and does not constitute investment advice. Always consult with a professional before making financial decisions.